All right, we're going to get started. So first of all, really want to thank everyone for joining. We know everyone's busy. It's the middle of the week, but we want to make this as impactful and valuable for everyone. So just a couple of things to call out. This is really for folks, whether it's individuals, advisors, CPAs, people who are thinking about estate planning, and in particular, how to pass on assets to future generations. And you're likely concerned about estate taxes or gift and estate taxes. And so really in today's webinar, we're going to cover like the basics of the gift and estate tax. Right now, it's a really important time because of upcoming regulatory changes, as well as what are Crummey trusts, how do they fit into this picture of estate planning, and what are some of the alternatives? So what are the different types of kind of products you can use for this type of estate planning use case, and really dive deep into what are the trade-offs and benefits, and really what are the ideal use cases for each of these structures. So it'll help you kind of better understand when to use that. Really kind of the key things we're going to talk about today are, so an overview, a brief overview of what is a gift and estate tax exemption and upcoming changes. This is something where your planning to pass on assets is really critical because that's dramatically changing. Basics of what are Crummey trusts and what do you use them for? What are the alternatives? And then really dive deep into what are the benefits, trade-offs, and use cases for Crummey trusts and their alternatives, and leave some time for Q&A at the end. So Peter, to just get started with this, just to make sure everyone's on the same page, what is the gift and estate exemption, and what are gift and estate taxes?
Yeah, so the gift and estate tax, so it's really two different taxes, but basically part of a unified federal tax system. So the gift tax is a 40% tax on transfers you make during your lifetime, and the estate tax is a 40% tax on transfers you make when you die. Like, if you leave a bequest to your kids when you die. There's a couple of important exclusions from these taxes, which is what prevents most people from paying, massive estate taxes when they die. So the big one is the lifetime exclusion, which is currently $13.61 million. It'll be about $14 million in January, but it's going down to about $7 million in January of 2026, at least under current law. And so that's one of the reasons most people don't pay estate tax. The other reason is there's an annual exclusion, which is currently $18,000 per donor for each beneficiary. And so if you have two kids, you can gift $18,000 to each of them each year, and that number refreshes every January 1st. And if you're married, you and your spouse together can gift $36,000 a year to each of your kids.
And just to kind of restate this, so it's each year, each individual can gift $18,000 to another individual, their kid, grandkid, as a part of their annual exclusion. So if you had one kid, each parent could gift $18,000 this year. That is tied to inflation, and that will just use up your annual exclusion, right, Peter?
Yeah, exactly. And so, the interesting thing about it is, if you have enough kids or enough grandkids or enough loved ones, they don't have to be your kids, and you make these gifts consistently year after year, the value can actually exceed potentially the value of the lifetime exclusion. So the lifetime exclusion is always fixed; it's per donor, but the value of the annual exclusion really depends on how many beneficiaries you have that you want to help out.
Yeah, and these pieces stack, right? So that's, you can give $18,000 per individual. So each individual can give $18,000 per beneficiary. And then once you get beyond that, that's where the $14 million current exemption comes into effect. And the piece to call out is starting January 1st, 2026, as the way the law is currently written. Obviously, there's an election coming up, and so there's a chance things change. But as the way it's currently set, that exclusion beyond the annual exclusion drops from 14 to 7 million. Do I have that right?
Yeah.
And so what that means is, let's say you've used up your annual exclusion and your lifetime exemption, you're going to at minimum lose roughly 40 cents out of every dollar to these taxes, right?
Yeah.
Got it. Now, and I just want to call this out is so that's kind of the basics there. And the gift and estate tax, this is obviously a big tax, 40% at the federal level, plus states have their own. It is a big chunk of change. The good news is gift and estate tax is probably the easiest tax to avoid. And with proper structuring, you can essentially completely avoid this at almost any net worth level. It just takes planning and focus on this to avoid that. Is that fair to say, Peter?
Yeah, yeah. I mean, so the nice thing about the estate tax is it applies when you die, but if you're 40 years old, you probably have 40 or 50 years to plan around it. So if you're 90, maybe you don't have as much time. There's probably still stuff you can do, but especially for relatively young people, there's a lot that you can do because there's a lot of time to implement strategies.
Yeah. And I don't want to beat a dead horse. The dollar, we can help you understand, set up these structures at no cost and manage them as well. We make this fairly easy and take away kind of all that complexity. Now that you have kind of the basics of the gift and estate tax, let's start with what are Crummey trusts?
Yeah, so a Crummey trust is a specific type of irrevocable trust that is designed to receive annual exclusion gifts. So not all trusts qualify for the gift tax annual exclusion, but Crummey trusts are drafted so that they do. And so that's essentially a Crummey trust is a trust that you can use to absorb that annual exclusion.
Yeah. So it's really optimized for that specific annual exclusion and to pass that on. Now, what's kind of the key benefits of the Crummey trust?
Yeah, so there are a few. So a couple of the big benefits are they can last for your beneficiary's entire lifetime. So let's say you want to set up a trust for the benefit of your 3-year-old grandchild. Um, you know that trust can last until the grandchild's 100 years old. It doesn't have to end at a certain age. And so that's one benefit. There's also some tax benefits that are a little bit more abstract. So I think it might make sense to talk about some of those benefits a little bit later. But basically,
Okay.
it's more tax advantage. It's more state tax efficient, and it's also it can last. It can last essentially for the beneficiary's entire lifetime, which means that the trust creditor protection never goes away as long as the beneficiary is alive. And so those are I think the two really valuable benefits. Um,
Yeah.
and it also means that the beneficiary doesn't get access to the trust assets immediately. Whereas if you made an outright gift, they would get the money immediately, which you might not want.
Yeah, and do you want to add just some colors to if I'm a parent and passing this on to my kid, what's the reason why I wouldn't want them to immediately have access to these proceeds, and what is the impact of being able to control that?
Yeah, so there's really three reasons you would want them to have immediate access. So first, sort of most obvious reason is if your kid's 18 or relatively young, you might not want the kid to be getting $36,000 a year to spend however they want. Um, Sort of the second big reason is creditor protection. If you give the kid $36,000 a year, that's money that's in their own name, and it's money that their creditors or divorcing spouses can come after because it's their money. If the money's in a crummy trust, creditor is not going to be able to go after it. So that's another big benefit. And then the third thing is just crummy trusts have certain tax advantages that aren't available if you make direct gifts.
That makes sense. And I just want to call it one term here. So you mentioned that it's estate tax efficient. maybe want to explain what does estate tax planning or being estate tax efficient mean, and then maybe contrast that. What does income tax planning mean in contrast to that?
Yeah, so estate tax efficiency is just referring to the amount of estate tax savings from a particular strategy. So I'll get into this more later, but the basic idea is that if you give $36,000 a year to a Crummey trust, you're going to end up saving your kids more than if you gave them directly $36,000 a year. And there's a couple of reasons for that, but the basic reason is that you're allowed to pay the Crummey trust taxes, which will sort of increase the amount of money in the trust because the trust is essentially getting $36,000 post-tax, whereas if you give them $36,000 a year and then they're paying taxes on the income from that money, then that's money that they're paying. The income they're paying tax on the income, so they're not going to wind up with the same compound investment returns.
Yeah, and maybe just let me frame it another way is if you're worried about estate taxes, what you're really solving for is how much can you pass on to future generations, right? And really, in some sense, you have X amount of assets, they're growing at X%, and there's really how much do you lose to taxes? And the more estate tax efficient a strategy, a combination of products slash the broader strategy is, the more you pass on to your kids slash future generations, whether it's grandkids, great grandkids, whatever that is. Really, it's the more efficient it is, the less you lose to the government, and the more you pass on to your future generations of your family. Income tax planning, just to the other side of this is it's really more you're trying to maximize what you keep, and so this is really typically focused on how do you reduce ordinary income taxes and capital gain taxes. So it's more of how do you maximize what you can keep and use for yourself versus what you pass on to future generations. And the critical piece is because these are different taxes, there are different strategies, different products that you use to solve for that. Is that kind of a fair explanation or anything I missed there, Peter?
Yeah, I mean, the other thing I would say is, income tax efficiency, it isn't just the amount that you have personally after taxes. It's also, it also matters in estate planning. So, for example, if you set up a trust, you could have the trust be located in a state that has lower taxes than your state. So if you live in California, you could set up a trust in South Dakota, which doesn't have an income tax, and that would be income tax efficient, even though it would really be saving your kids money, not you personally.
Okay. Now we kind of got that. Let's go into what are the alternatives to Crummey Trust? So in this world where you're worried about estate taxes and want to gift it to your kids or kind of help set them up or grandkids, future generations, maybe just start with what are outright gifts? Like, what does that practically mean? And kind of, what are the benefits, trade-offs, and what's the common use case?
Yeah. So an outright gift is the simplest of these three alternatives. So it's just giving money to someone directly, transferring money to their bank account. And so, the obvious benefit is it's very simple. It doesn't cost any money. It's just literally wiring money from your account to your kid's account or your grandkid's bank account. But it's also probably the least desirable option for a few reasons. So first of all, if you have minor children, you can't do this at all because minors can't open bank accounts. A 10-year-old can't go to Wells Fargo and open an account. So for this to work, the kids have to be at least adult, at least 18. And then even then, there's a few pretty significant trade-offs. So one is you're totally giving up control over the money. So it's completely out of your hands once you transfer it to the kid's bank account. So that's sort of number one. Number two, because it's the money's not in any sort of trust structure, you don't get the same estate tax benefits that you can get from a Crummey trust. So you can't pay your kids taxes the way that you can pay a Crummey trust taxes. I mean, you can But if you pay your kids' taxes, that's a taxable gift. Whereas if you pay your Crummey trust taxes, it's not. So
Yeah, and so maybe what's the use case? Because what it sounds like to me is this isn't kind of broad estate tax planning of outright gifts. It's a simple, hey, your kid maybe needs X amount of money for whatever type of expense, like unexpected expense or something
yeah.
like that. Is that the use case, or is there another use case where an outright gift would make sense?
Yeah, I think that's right. I think where it makes sense is if you're making maybe a one-time gift of $18,000 to your kid, you're not planning on repeating it, or you're just gifting small amounts like $1,000 a year or something, and then you just think, oh, this is just easier than setting something up. But in general, it's not the most optimized strategy ever.
Now let's go to custodial accounts. What are custodial accounts? Do they have any other names, and kind of how do they work?
Yeah, so custodial accounts have a few names. So they're sometimes called UTMA accounts, which stands for the Uniform Transfers to Minors Act. They're occasionally called UGMA accounts, which stands for the Uniform Gifts to Minors Act, which is a statute that preceded the Uniform Transfers to Minors Act. But the basic idea is that because children can't open up their own bank accounts, state legislatures passed legislation called the Uniform Transfers to Minors Act that says that a custodian, usually a parent, can open up an account on behalf of a minor. And basically, the custodian invests the money, runs the account, but can't take distributions because the money's earmarked for the minor. But what happens is that because it's the minor's property, they're entitled to the money basically at either 18 or 21. And so, unlike a Crummey trust, which could last until they're 100 years old, these accounts, custodial accounts, have to end when the kid's basically college age. And so that means that the money is going to be, in your 21-year-old's hands. If you put $36,000 into a custodial account every year from when the child's a baby, by the time they're 21, assuming 9% returns, there's going to be over $2 million in that account. And so your 21-year-old is going to have $2 million, which they can spend on whatever they want to spend $2 million on, which might not be, what you would want them to spend the $2 million on.
Got it. And this is so, I'm kind of curious as to how would the use case between the custodial account versus outright gift differ? Like, what's the kind of scenario where you think it really makes sense to use a custodial account?
Yeah, so custodial account. So to me, custodial accounts and outright gifts have a lot of the same limitations. What custodial accounts can do is that they can fill the role of an outright gift for a minor beneficiary, and so you can't gift $10,000 to your 8-year-old grandchild. It's not possible because the 8-year-old doesn't have a bank account, can't open a bank account. But you could open a custodial account. It's easy to do. You go to your bank, you say, I want to open a custodial account. Here's the name and social security number of my grandkid. I want to be the custodian. So it's easy to do. It's not super.
It's essentially the kids' version of outright gifting because you can't
Yeah.
outright gift to kids. Is that
Yeah,
a
it's
fair?
like the kids' version of an outright gift. Yeah.
Okay. Now let's go to 529s. Potentially something more folks have heard of. Maybe let's just give kind of like an overview, benefits,
Yeah.
kind of trade-offs, and how this makes sense. Or what
Yeah,
it makes sense.
So 529 plans, like custodial accounts, like outright gifts, like Crummey trusts, also use your annual exclusion. And so if you fund a 529 plan with $18,000, that's going to use up your annual exclusion for that beneficiary. So a 529 plan is an educational savings account essentially, but they're highly tax advantaged. And the main tax advantage is that, like a Roth IRA, the money that you put into the 529 plan is after tax. but any income earned inside of the plan or when you cash out isn't taxed as long as the withdrawals go to sort of qualified educational expenses. So, like tuition for school, it could be a private high school, could be a private college, could be a graduate school. Um, any educational institution that's charging money, you can use to you can withdraw funds to from this 529 plan.
So it sounds like the kind of the use case is you really want to there's an additional income tax advantage of these as long as you're sizing the amount you use a 529 plan for to
Yeah,
essentially kind of your kids' estimated educational costs.
yeah.
And because you lose that income tax advantage if it's for non-educational expenses. So
Yeah, so exactly. So I would say in general, the most attractive strategies that we're talking about today are 529 plans and Crummey Trust. Um,
yeah,
the difference is, you can put $2 million into a Crummey Trust, but by contributing 36,000 a year for 21 years, you can even put, if you keep contributing, after 30 or 40 years, it's going to be much more than that in a Crummey Trust. With the 529 plan, you don't really want to contribute more than, I don't know, 50, 60, $70,000.
depends on when
Uh,
you start contributing, right?
yeah,
Because
it depends on when you
accounting,
start contributing. If you start as a baby, you don't need to contribute as much.
yeah,
If you start when they're 12, maybe you need to contribute more.
yeah,
Um, yeah, but in general, you don't want $2 million in your 529 plan because you won't be able to get the money out without paying penalties. So you'd rather have, so it might make sense to fund the 529 plan for 3 years or something when the kid's a baby, but you don't want to be funding the 529 plan every year for their entire
yeah,
childhood. And so what a lot of
yeah.
people do is they might fund, um, a 529 plan until the kid is 3 or something, and then after that they can fund a Crummey Trust, or they might gift, $10,000 a year to the 529 plan and $8,000 a year to the Crummey Trust. Something
Yeah.
like that. They're just not. They're mutually exclusive to the extent that they're both using annual exclusion, um, but they're not mutually exclusive to the like in the sense that you're going to be giving to a 529 plan for your kid's entire life. It's usually
Yeah.
a short period.
Yeah, and a broader thing, all of these strategies, and that's why we kind of call the alternatives, is using this annual, typically people use for this annual exclusion, right? And to kind of Peter's point, right, like from a tax advantage, people often view Crummey Trust and 529 plans as the most advantaged. And the real idea is you do a limited amount in this 529 plan for what is kind of estimated educational expenses. And then above that, the educational expenses accounting for the investment growth. Then above that, you're using the Crummey Trust. But
Yeah,
let's kind of
and
let's
the one more thing I'd point out about 529 plans. So with the 529 plan, you're essentially limited to the investments that the 529 plan allows. And so there'll be a menu, and basically 529 plans allow you to invest in index funds, um, but you're not going to be investing a 529 plan in like your real estate projects. If you're a real estate person, you're not going to be investing in some more sort of unusual investments. So sometimes people, sort of make the calculation that the index funds are going to return maybe 8% a year. And it's all post tax because there's no tax on those investment returns, but inside a 529 plan. But if you don't fund a 529 plan, let's say you're a real estate investor who thinks they're going to earn 16% returns on their real estate investments over the next 15 years. The post tax returns outside of the 529 plan might actually be better than the post tax returns inside the 529 plan if you have those higher return investments available.
now here's kind of a this is really a deep dive in terms of Crummey Trust and alternatives and how they work. So maybe we can start with kind of just we'll start with because this category came up is Well, let's start with the simplest. We'll go right to left, actually. Duration, what does that category mean, Peter, and like why is that important?
Yeah, just saying the duration of the planning structure. So crummy trusts are green because they can last for the kid's entire lifetime. There's no limit. Um, Outright gifts are red because as soon as you transfer the money, it's that's it. It's in the kid's hands. Custodial accounts and 529 plans can last basically until the child's an adult. Eventually, the money is going to come out or be spent. Um, so that's why they're yellow.
Yeah. And just to address kind of, so this question is for all of these options here, um, the all of these structures here are using that same annual exclusion. So to John directly answer, you can't gift $18,000. So if there's a crummy trust, that's set up for Peter, his parents couldn't put $18,000 in that crummy trust for him and directly gift him $18,000 in the same year. Is that right, Peter?
Yeah. So you can't do both. So the way both crummy trusts and direct gifts to beneficiaries work and 529 plans work is that the annual exclusion is per beneficiary. And so, you have your kid Tommy. If you make an $18,000 gift to Tommy directly, that's using Tommy's your full annual exclusion with respect to Tommy. And so you can't then make a gift to a 529 plan for Tommy or a crummy trust for Tommy because you've already used Tommy's annual exclusion. What you could do is you could make a $6,000 gift directly to Tommy, $6,000 gift to a crummy trust for Tommy, and a $6,000 gift to a 529 plan for Tommy. But it's cumulatively $18,000 per person per donee.
Yeah. Now, estate tax efficiency is probably potentially one of the most important categories here.
Yeah.
We'll start with like, so what does this at a high level, and correct me if I'm wrong, what this means is how much are you assuming you're facing or potentially might face the gift and estate tax? Really, the more efficient, estate tax efficient these strategies are, the more you'll pass on to kids or future generations. Is that fair to say, Peter?
Yeah,
Now,
exactly. Yeah.
now the reason that because this is an important piece, and this goes to kind of Charles, your question. Maybe let's dive into why are crummy trusts so estate tax efficient, Peter.
Yeah. So there's a couple reasons. So one reason is specific to custodial accounts. So custodial accounts, if the custodian dies um, during the during the term of the custodial account before it ends, in some cases the money could be included in the custodian's estate for estate tax purposes. So that's a specific issue having to do with custodial accounts. There's no equivalent issue with crummy trusts. So when you give money to a crummy trust, it's totally outside of your estate, no matter what happens. So that's sort of one advantage, but more big picture in general, crummy trusts allow the donor to pay the trust taxes. So that essentially the trust is disregarded for income tax purposes, typically, but not for estate and gift tax purposes. So to answer this, also goes back to John Busco's question. So crummy trust is generally disregarded for income tax purposes, but not for other purposes. And so, yeah. So what happens is, let's say you have,
And just by the way,
$2
I
in a
just want to
crummy
point out
trust.
this is a really just important and big piece as to you can gift assets to the crummy trust, put them outside of your estate, and so what that means is if you gift $18,000 and that grows to $50,000 over 20 years, that appreciation doesn't count as being inside of your estate and won't use up any of your exclusions, or you won't face any gift and estate taxes. Once you gift the
Yeah.
assets outside of your estate, all the growth is estate tax free. But you can pay the taxes on whether it's yield, dividends, capital gains on the investments inside the Crummey Trust. And so this is where you have that $18,000 annual exclusion, but because you're paying those taxes, it's almost like that exclusion is higher because you can pay the taxes for the trust and that doesn't count as part of your annual exclusion or lifetime gift exemption. Is that right, Peter?
Yeah. Yeah, exactly. And so it's maybe a little bit counterintuitive, but what happens is, so let's say there's, you've been giving to the Crummey Trust for a long time. It's been generating some sort of investment return. There's $2 million in the Crummey Trust. So at that point, the income taxes on the Crummey Trust are going to be pretty significant. Depending on what you're investing in, you could easily be paying tens of thousands of dollars a year in income tax on the Crummey Trust behalf. But because you're technically liable for the trust income taxes, the IRS doesn't consider that a gift. It's a non-gift. So essentially, you could keep making your $18,000 or $36,000 gifts to that Crummey Trust, and you can pay the $40,000 or $50,000 a year of income tax liability that the trust is incurring. And so essentially, you're getting your annual exclusion gift, and you're getting to pay the trust taxes without using any lifetime gift tax exclusion. And so you might actually be transferring the equivalent of $100,000 a year to the trust instead of $36,000.
Yeah, and just to even add on, so that's the big, like, you transfer $18,000. Then on this $2 million portfolio, there's $50,000 of taxes that you can pay. And in part one is it's reducing your estate, the value of the assets you have in your estate, which means in the future, you're less likely to face estate taxes. But even potentially just as importantly, it means the trust keeps that $50,000, which it gets to reinvest and grow. So there's one part is you reduce your estate, which means less future estate taxes, but then also your children or grandkids or whoever is a beneficiary of that Crummey Trust, it means the trust gets to keep that money and create more wealth for them. And that's kind of it's the double win there.
And so to more directly address Charles's question about so the donor could pay the income tax on the distributions for the kids. So what it is this is only while the money's inside of the trust. So distributions from the Crummey Trust to the kids, as long as the trust is set up the way that Crummey Trusts are typically set up, which is as what's called grantor trusts, which are disregarded for income tax purposes. The distributions aren't taxable, and so you could distribute, the entire amount if you wanted to from the Crummey Trust to the kids, and that wouldn't be income to the kids. And it wouldn't be income to the grantor either. The distribution would be disregarded. But as long as the money is inside of the trust and hasn't been distributed, you would be paying the taxes on the capital gains, on the interest income, the dividend income, whatever it is.
Yeah. And now just to kind of, so this is why it's like by far and away, Crummey Trusts are the most kind of impactful for estate tax efficiency beyond funding your kids or grandkids' educational expenses. Now, move on to creditor protection. We briefly mentioned this before. Peter, just want to give kind of a quick synopsis of what that is and why Crummey Trusts and 529 plans are stronger in this area.
Yeah, so there's two big concerns that people have around asset protection, basically. So one of the big concerns is just that you or your kid, whoever the beneficiary is going to get sued by somebody for, some reason. Maybe they're a doctor and they have a malpractice lawsuit. Maybe they get in a car crash or something, or somebody falls on their property. So one thing a Crummey Trust does is it shields the money both from the donor's creditors and also from the beneficiary's creditors. So as long as the money is in the trust, nobody's going to be able to come after that money unless they have some claim against the trust itself, which is highly unlikely. And the other thing is, a common thing that we see is kids get married. The parent or grandparent is at least a little bit concerned about a possible future divorce. Um, and one of the nice things about irrevocable trust in general, including Crummey trust, is the assets inside of the trust are clearly not the spouse's property. And so if they get divorced, that spouse isn't going to be able to claim that they own half of the trust. Whereas if you give the kid money directly, they might have a stronger claim that they deserve half of that money.
Now, we've talked about kind of control last that hey, the reason Crummey trusts stand out here is they can beyond once a person becomes an adult, these Crummey trusts can still keep going. While custodial accounts and 529 plans kind of end then, and outright gifts, you give control once you gift it to them. Now, fees, maybe you just want to talk about kind of really it's just, outright gifts, custodial accounts, they're simple 529 plans are simple, low cost. Cheap, they are cheaper than Crummey trusts. I'll just call out. So one of the big advantages of Valor is we can help you set up a Crummey trust at no cost today, and our fees are a fraction of kind of what the industry is. But just to be candid, it is still significantly more expensive. $1,000 a year for the Crummey trust, which is more expensive than these other options. So it does really make sense if you're putting more into the trust versus, again, most of these other things are for smaller amounts, but they are cheaper in that regard.
Yeah.
Now, there's. Go ahead.
I was going to say the one thing I would say is, if you contribute every year to a Crummey trust, after a few years, there'll be over $1 million in the trust, at which point the $1,000 a year for administration becomes pretty small, almost negligible. But yeah, Monty's right that, an outright gift obviously is free. And so this is a little bit more expensive.
Yeah, and that's what's like. I think the easiest way to think about this, right, is like for estate tax, like the outright gifts and custodial accounts, as we mentioned, this is if you're just really giving kind of small one-off amounts to kind of your kids or future generations. 529 plans, you're really limiting it to what do you expect the future value will be to cover educational expenses. Crummey trusts are for kind of when you're planning for bigger dollar amounts. Now, there's kind of a related question here from Nirav is it possible to really move large amounts into a Crummey trust to start with?
Yeah, so it depends what you mean by large amounts. So in theory, you could put more than $36,000 a year into a Crummey trust, but it sort of defeats the purpose of the Crummey trust, which is to avoid making taxable gifts. So you'd actually be making a taxable gift, and so you'd have to file a gift tax return, and you'd use some of your $13.61 million lifetime gift tax exclusion. And so if you were making a large, like $1 million gift, you'd probably not want to use a Crummey trust. There's better vehicles for that. Crummey trusts are really optimized for these smaller, $18,000 a year gifts. But you could in theory. In terms of how you move the money into the trust, it's the same as most trusts. So basically, the trustee of the trust would open a bank account in the name of the trust. Typically, the trust doesn't have its own EIN. Typically, it uses the donor social security number.
The grant.
And so you go to So you go to Fidelity. You say I have this, the Nirav Crummey trust. Monty's the trustee or whatever, and then you open the account, just like you would open any other bank account, and then you transfer the money from your account to the trust account.
Yeah, I mean, the two pieces of that on is, so typically we take care of this for folks to make it fairly straightforward, or we work with you and your financial advisor to manage those things. The other piece I'd call it is, again, if you really, kind of want to get a large Crummey trust thing. So there's other structures like, just to like, if you're doing larger, the Crummey trust is really built for those annual exclusions. So, this is again, between two parents, you can, in today's world, give 36,000. To get a large amount, you're really playing a time game of doing that repeatedly every year and compounding that. If you want to do larger amounts that are potentially beyond your annual exclusion and using your lifetime gift exemption, or you typically use a structure like what's called an IDGIT, intentionally defective grantor trust. By the way, just as a little bit of, we have our webinar on September 25th, so 4 weeks from now, is on these, and this is where you'd make those larger multi-million-dollar gifts too. To start with, you'd use that versus a Crummey trust. I'm not going to get too deep down that rabbit hole today, just because it's an entirely different subject, but really the Crummey trust is for that really annual exclusion. The other piece just to call out is, one, if you have questions, first of all, and we're seeing this come in, is let us know in the comments if you have any other questions. If you want to directly chat with us, you can schedule time at that link. You can email us directly. 2 weeks from now, we have a webinar on deferred sales trust. It's a vehicle to help defer capital gains and some kind of alternatives. And then 2 weeks after that, 4 weeks from now, we'll be talking about intentionally defective grantor trust, which is the most commonly used trust for estate tax planning and typically holds larger amounts beyond the annual exclusion that Crummey trusts use. Now, to get to some of these questions here, Michael is saying, is there options for moving over an overfunded 529 to a Crummey trust?
Unfortunately, no. The 529 plan, 529 rules are pretty restrictive. And so Congress did enact make a minor change to the 529 statute, I think about a year ago, saying that you can use $35,000 from a 529 plan to set up a retirement account, an IRA, for the beneficiary. But other than that, basically any money that you withdraw from a 529 plan that's not going towards qualified educational expenses is going to trigger penalties. And so there's no easy way to do that right now. Maybe in the future there will be. But right now, under current law, there's not.
Yeah. Now another, I think this is a really good question from John what's the best way to fund a Crummey trust using that annual exclusion? Is it cash, appreciated assets?
Yeah, so this is a good question. So the answer is either cash or appreciated assets work. So there's no, it's not like a charitable gift where you get you're like getting a deduction or some sort of like tax avoidance by transferring sort of an appreciated asset. So there's no real benefit of transferring appreciated assets, but if the alternative is selling an appreciated asset in order to generate cash to fund the Crummey trust, you don't want to do that because that triggers capital gains for you. So in that case, I'd say you'd be better off just transferring the appreciated asset rather than converting it to cash. But you can also transfer cash and then invest in the stock market or whatever you invest
in. We'll give another minute for if any other questions come up. But again, if you want to directly chat with us, you can feel free. There's no cost. You can schedule that there. You can also email us directly. We'd also love to, if there's other topics you would love to hear us talk about or you want to dive into, let us know in the comments or email us. And we're going to be regularly doing these webinars. We're doing them every other week. We'll probably start increasing these to every week. So if there's topics or areas that you think would be helpful, please let us know, and also happy to directly chat. But otherwise, really appreciate everyone taking the time to join us, and looking forward to doing it again. Thanks, everyone.